Imagine Europe and India haggling over a car price at continent scale. We're talking tariffs, EVs, and who gets to sell what, where. Imagine buying a European car in India and not paying half the price in taxes. Sounds fake? Welcome to the India-EU vehicle trade conversation. Headline: India and the EU are dialing in a cleaner, fairer car trade. Think: lower duties on parts, clearer EV rules, localization incentives, and smoother customs. Goal: more cars built, shipped, and sold, without red tape traffic jams. So, why is this happening now? The simple answer is that global supply chains are undergoing a seismic shift. After years of unprecedented shocks, from pandemics to geopolitical friction, the old models are breaking. Businesses and governments are urgently seeking resilience, building new, more reliable networks for trade. This isn't just about recovery, it's a strategic rewiring of the world's economic arteries, creating fresh opportunities for nimble, ambitious economies. For Europe, the goal is clear: secure its electric vehicle future with competitive, affordable models. For India, it's a golden chance to accelerate its manufacturing prowess, absorbing high-end technology, creating skilled jobs, and boosting its export economy. Both sides recognize the immense strategic value in diversifying their supply chains, moving away from a risky overdependence on any single country. The key lies in harmonizing regulations. If the rules for critical components like batteries, motors, and software align, these parts can flow between continents with far less friction. The translation for automakers is simple: cheaper vehicle builds and quicker launches. For consumers, it means more choice and better prices, and for investors, it signals a more stable, profitable, and predictable future. The speed bumps: tariffs on finished cars still bite. Rules of origin decide what counts as local. Safety and emissions standards must match. No shortcuts. Software, data, and recycling rules add extra paperwork. Tidy the rulebook, and volumes can really move. So, who stands to gain the most from this landmark trade agreement? The clearest winners are Indian automotive exporters, who will gain unprecedented tariff-free access to the vast European market. Simultaneously, major EU brands are poised to double down on their Make in India strategies. By expanding their manufacturing footprint, they can leverage India's competitive production costs and tap into government incentives, creating a powerful export hub. This manufacturing boom creates a massive ripple effect across the entire supply chain. Local component suppliers will need to scale up production dramatically, from advanced battery packs and electric motors to sophisticated infotainment systems and connected car technology. Ultimately, the Indian consumer is a major beneficiary. Increased competition and local production will lead to a wider array of electric vehicle choices and, crucially, more aggressive pricing. However, the road ahead isn't without risks. Businesses must navigate potential policy U-turns, the volatility of currency exchange rates between the rupee and the euro, and the significant compliance costs associated with meeting stringent EU standards. The net outlook remains positive, presenting a solid upside. But realizing this potential hinges on one critical factor: ensuring that efficient execution and strategic investment can overcome the hurdles of red tape and bureaucracy. So, what's the final verdict on the India-EU vehicle trade standoff? It's less of a trade war and more of a high-stakes negotiation over the future of green mobility. Think of it as a crucial rules upgrade for the entire automotive industry, setting the stage for a new era of global competition. On one side, the EU is pushing its stringent environmental and safety standards, aiming to protect its market and promote its green agenda. On the other, India is leveraging its massive manufacturing power, seeking to become a global hub for affordable, quality vehicles. The core tension lies in harmonizing these ambitions. If negotiators can successfully align on key regulations and create a phased reduction in tariffs, we could see a surge in vehicle shipments by 2025. This would mean more choices for consumers and expanded markets for manufacturers on both sides. However, if they miss this window of alignment, the momentum will stall. We'll see increased friction at customs, supply chain disruptions, and a fragmented global market where innovation is stifled by protectionism. Want to stay ahead of major shifts in the global economy? Get fast, jargon-free updates just like this one. Follow Econmatrix for daily 30-second insights into the world of global trade.